Every evening, you hear headlines about the Indian stock market, often mentioning the Sensex or the Nifty. The Sensex surged 500 points, or the Nifty closed in the red, and we understand this means the market is up or down. But have you ever truly asked yourself, what is the real difference between these two indices? More importantly, which one is telling the real story of the Indian market? For decades, this has been the central debate in Indian finance. Is it the Sensex, the 30-stock legacy index from the BSE, established in 1875? Or is it the Nifty 50, the broader 50-stock barometer from the NSE, the choice of modern traders, established in 1992? Today, we go beyond the textbook to dissect these indices as a portfolio manager would. We will look at the math, weightings, and historical proof to answer one question. Which index truly represents the Indian market? The answer is not as simple as you think, and it will change how you view the market. First, let's get the textbook facts out of the way. The Sensex, or Sensitive Index, is the flagship of the Bombay Stock Exchange, established with a base year of 1978 to 79 and a base value of 100. It comprises 30 of the largest, most actively traded stocks in India. The Nifty 50 is the child of the National Stock Exchange, established in 1995 with a base value of 1000. As its name suggests, it tracks 50 stocks, offering a broader market perspective. Both indices use the same crucial methodology, free float market capitalization. This is critical, as an index isn't moved by a company's total value, but by shares available for public trading. The bigger a company's free float value, the more weight it has impacting the index. This is where most explanations stop. But this is where our analysis truly begins. The core difference is not merely 30 versus 50 stocks. It's a fundamental argument between focus and diversification. The Nifty's primary argument is diversification, casting a wider net with 50 stocks. It covers 24 distinct sectors, providing a more granular representation of India's evolving economy. But the Sensex camp argues for focus, preferring the 30 blue-chip leaders that truly drive the economy. The Sensex is an index of power, offering over 40 years of data and an unparalleled historical perspective. But let's see what this really means by looking at the numbers. This is the aha moment. As of late 2025, let's compare the weight of the top 3 companies: HDFC Bank, Reliance, and ICICI Bank. In the Nifty 50, these 3 giants make up roughly 30% of the entire index. Now, look at the Sensex. The exact same top 3 companies make up over 36% of the index. What does this tell you? It's concentration risk. A sharp move in just HDFC Bank, for example, will have a visibly larger impact on the Sensex than on the Nifty. The Sensex is more top-heavy. Its fate tied more closely to its biggest champions. The Nifty, with its broader base, diffuses that risk. This is a critical structural difference. For 95% of trading days, these two indices move in lockstep. Their 10-year correlation is over 0.99. But as an analyst, I care about the 5%, the periods of divergence, because that's where we find the truth. These divergences happen during times of sectoral rotation. In 2021, when energy and old economy commodity stocks rallied, the Sensex often outperformed the Nifty. But in 2022, when banking and financial services led, the Nifty's broader basket gave it a slight performance edge. This brings us to long-term performance. From 2010 to 2020, the Nifty 50 slightly edged out the Sensex. The Nifty 50 posted around a 12.7% return to the Sensex 12.3%, a small but meaningful gap. Many analysts attribute this to the Nifty's broader base, capturing more upside from a wider range of companies. So, we come back to our original question: Nifty 50 versus Sensex. Which one truly represents the Indian market? The answer, from an expert's point of view, is this: the Sensex is the ultimate barometer of India's blue-chip corporate health. It tells you what the 30 biggest, most established drivers of the economy are doing. It is an index of legacy and power. But the Nifty 50 is, by its very design, a better barometer of the overall Indian market sentiment. Its 50 stock, more diversified structure provides a more stable, less concentrated, and holistic picture of the entire economy. There's a reason it's the benchmark of choice for almost all foreign institutional investors, domestic institutions, and all index-based mutual funds. Most importantly, the Nifty is the basis for the entire Indian derivatives market, with Nifty futures and options among the most traded contracts in the world. That tells you where the smart money has its focus. So, which should you track? As a wealth manager, I tell my clients to track both. But when you build your own portfolio, ask yourself this: are you trying to beat the 30 giants of the Sensex or the 50 stock market at large of the Nifty? For most investors, the Nifty 50 is the more relevant, real-world benchmark to measure your own success against. This is the kind of in-depth analysis we do every single week. If you want to move beyond the headlines and truly understand how the market works and how to build lasting wealth, I invite you to subscribe to this channel. And now, I want to hear from you. Which index do you personally track? Let me know in the comments below.